Michael Manaskainen here, Army veteran turned real estate investor and coach. Over the last 5 years, I've built over $22 million of real estate using none of my own money. My goal is very simple when I do stuff like this. I want to help you do the exact same thing, but even faster. What I specialize in the area of real estate investing is capital raising, creative financing, deal analysis, and my favorite management strategy is the co-living or rent by the room strategy. If you don't know what I'm talking about, watch any and all of the videos that I've already provided. I also have a free community called Wealth Through Real Estate. I'll drop the link for you shortly, but I share free courses, tools, and other resources, including a real estate investment calculator that handles all forms of creative, traditional, and all the different management strategies in my free Wealth Through Real Estate community. The link for that is in my Instagram bio. I will also drop it here. And for any of you that are currently real estate investors that are looking to scale, I have a super investors mastermind that shows you how to cash flow more, buy smarter so you get more bang for your buck per deal, and ideally using little to none of your own money so that you can achieve financial freedom faster. If that's something that you're interested in, reach out to me on Instagram or Facebook to learn more about that. So with that being said, let's get started. Today is going to be a very cool training in which I have a guest coming on and I will help them live analyze and structure a creatively financed deal. I'll provide all the context when we get over there. I just want to show you a few things beforehand. Let's get right into it. So I mentioned my Instagram, right? So if you want to get on there, it's Michael MNAT, super easy, right? MNAT right here. If you want to go on Instagram, this is where I drop a lot of these links that I'm going to be connecting you to. Some of you guys are already watching live on YouTube. If you're not, go here. I provide very detailed long form trainings and why I buy the way that I do, how I've scaled and all that good stuff. I don't think I've ever made a video less than 20 minutes. So it's all long form detailed stuff to help you guys out as much, in addition to what I provide with my Wealth Through Real Estate. So when you go here, right on Instagram, you can click this. I have an upcoming workshop. It's an in-person 2-day event to teach you everything you need to know about buying your first or next co-living deal, maximizing your returns, getting the renovations done cost effectively, furnishing your properties, all the checklists, tools, analyzing, all that stuff is included. So if you click that link, it'll take you right here. I'll provide you way more context. And I've got some sponsors for the event. So instead of the full price, I've got a 60% discount going on for anyone that wants to join. So you can come in at $997. Not only do you get all the benefits of in-person and all the education, all that, but you also get the recordings, the tools and resources. So some people who have joined who can't even make it in person. So what they're doing is they're just going to get the benefit of all the education, tools, resources sent to them for a fraction of the cost of what most co-living educators provide. I'm giving it to you guys. And why me? Well, I've probably got the most co-living rental properties out of the majority of people that I know. The majority of investors out there, the majority of educators, I have a ton of co-living. I've been doing this for several years now, and we own in multiple states, and you need to understand how to do this, but also how to effectively grow and scale your portfolio. It's not just about buying a property, right? That's the start. It's about doing that and then scaling it so you can actually be free from this. So go ahead and check it out. All the info is in there. The link is in my Instagram bio. And then for Wealth Through Real Estate, right? The calculator that we're going to use and all that good stuff, I want you to know how to access that. So you just click this link and you will get this page. From here, you can go and join Wealth Through Real Estate right here by clicking this link, absolutely for free. YouTube, Instagram, all here. If you want to download my free Creative Finance Calculator, that is in here as well. You can go ahead and just get a free copy sent to you directly via email. If you are someone who wants to understand what types of deals that I'm buying, or you want a bird dog for me, that information is here for you. I have free trainings on how to bird dog if you have no idea what I'm talking about. Or if you want to learn more about super investors, that's all here as well. You can also join Wealth Through Real Estate right here. So this is Wealth Through Real Estate, my free school community. It's not just the discussion, people ask questions, get answers, connect, collaborate. There's 1,600 people and we're growing every day in there. More importantly, or just as importantly, I give away tons of free courses for you guys. I charge for like 3% of my education that I have out there. 95+% of what I put out there is completely for free to help you guys succeed. My paid stuff is for those that are already doing the thing, that already have cash reserves, have active income needs met. We're looking to truly scale to financial freedom through building a portfolio. For those of you who are just starting out, just learning, maybe you don't have your active income needs met or savings and reserves, super investors doesn't make sense for you. So what I do is I give you free courses, free tools and resources, as well as some of the trainings in Super Investors that I think is really beneficial for you, like understanding your financial freedom path and how you're going to get there so that you can benefit. With that being said, you can come in here, click this link. Most of the links have it. You can also grab the calculator by clicking this. Click that, take it to the same page. Just fill out this form and you'll get the calculator that we're going to be using, at least the majority of the functionality of the calculator that we're going to be using through here. Oh, whoops. It just takes you back to this, right? So it takes you back to there, get the calculator. Additionally, if you are someone who's watched a lot of my videos and say, hey, I want to buy and hold real estate, but I don't want to do all the work myself, I get that. That's why I have a lot of capital partners, people who partner with me to get solid returns on their money, get ownership, learn throughout the process. You can fill out that form here. With that being said, let's get right into it because this is going to be a very interesting training. So I'm going to have a live guest and we're going to run through it. Let me bring her up first to give us some context, but this is the calculator that we'll be utilizing for this training. So just to give you a quick overview, right? We're going to go over all of this. This is going to be a creatively financed investment where there are multiple loans in place on this, and there's going to be a structure of potentially taking over a primary mortgage subject to. They're going to pull out a HELOC to reduce the entry costs for the investor, which is going to be taken over subject to seller financing and potentially capital raising. And she is going to live in part of it and then rent out the rest. I don't fully have the context, so we're going to get into that right now and start analyzing live together. What I want you all to do is be as interactive as possible because I'm going to potentially skip through things because it makes a lot of sense for me already. I want to know, where do you have questions? Where am I going too fast? I want you to benefit as much as you possibly can from this. All right. So with that being said, Lourdes, are you ready? Let me see based on your camera if you're ready. So what we're going to do today, guys, is we're going to analyze this deal in full. Lourdes wants to know, she wants to understand how to structure this investment, what the returns will look like, and if there's an ability to make it an even better investment based off the seller's motivation and what context she has. So with that being said, I'm going to put some high-level information. I don't want the address or anything for this. I'm going to trust your comps, right?
Okay, yes.
Based on your comps. If we give that, everyone's someone might go and hijack your deal. That's
okay.
All right. So I know this is Colorado. We'll leave it at that.
Correct.
Bed and bath currently.
6 and 4.5.
And this is multi-unit or?
It's a single home, but it's really split up to use as an Airbnb.
Okay. Well, house hack and co-living. Okay. So what's the size? Do you have the square footage roughly?
3,750.
3,750. All right. Let's talk about the seller's motivation, right? Let's talk about some high-level things that I'll plug and play.
Yes.
Sellers, just to give everyone context, sellers typically do not go creative unless there is a motivation. There has to be a reason in which they are not either able to or want to sell traditionally. Like most people, they get an agent, they list it on market, someone buys it, they take out a new loan, they pay them off, and they move on. If someone is willing to do creative, there's got to be a reason for it. Sometimes it's their property's not selling for the price that they want, so creative will give them a higher purchase price. Or maybe they don't want to get hit with all the taxes by selling it and getting all the money at once. So you spread out the payments through seller financing so they don't get hit with everything all at once. Or maybe they have little to no equity. So if they sold it, they'd have to pay money to sell it. Or they're behind on payments, whatever. There's a variety of reasons, but there needs to be some motivation for someone to sell creatively as opposed to traditionally. So that's why I really want to understand, what is the seller's motivation and what are some of the foundational pieces of information about their debt currently so we can structure the best deal. Because I see lots of people try to structure a deal and then give a crazy example, but someone is selling it for $200,000. Their loan is $200,000 and they say, yes, I'm going to seller finance it. Well, you can't. Like there's a bunch of debt in place. They don't have equity to seller finance. So they don't understand the right way to structure, create a finance deal. Like, does it actually make sense for that? And is it solving their problem? Right. So with all that being said, motivation, what do you know about this seller?
So he purchased that property 6 years ago at 341. He's got a lot of equity in it right now. We did some of the comps with some of your underwriting people, and we're looking at somewhere like 2,630 to 670. That's a large spread.
Is this listed on market?
It is not listed on market.
Okay.
It's off market.
So there's no specific price that the seller has said that they wanted up to this point, or have they? Has the seller specified a specific price that they want to sell this property at?
Yes.
What is that?
That's 650,000.
Let's stick with that for now.
Okay.
Okay. based on your conversations, is that kind of what you're looking at? And you just want to structure creatively?
I'd like to structure it lower, but if that's what he's asking, I think he's asking this amount for like a future play. So if he's giving me an option to buy it, so right now he's not outright telling me he's going to sell it to me. He's going to give me an option to buy it.
Option to buy it creatively?
Creatively.
So-
So I'm taking over a sub 2 mortgage in place. The first mortgage is at 286.
All right, let's put that sub 2. So it's 286. And what interest rate?
3.9.
Do you know what the PITI is, like the monthly payments on that?
$2,083.
And that's principal and interest of the loan, taxes and insurance?
Correct.
Okay. So we're going to have to fudge some of that now, unless we have a mortgage statement, all that. We'll get to that soon. Okay.
I don't have a mortgage statement.
So we're going to, okay. Let's just put in some numbers to help everyone understand. So using this calculator, you can do, I want to show you real quickly. You can analyze deals cash. So if you bought it all cash, you buy it traditionally, so taking out a new loan, you buy it leveraging just seller financing, just subject to, or hybrid, which is this one. There's going to be a component. How do I know? Because he wants to sell it for $650,000. His loan is $286,000. The rest of that, right, has to either be paid off in full up front or some form of seller financing or another loan in place, which is going to be potentially the HELOC. All right, so let's start with the $650,000. One thing to understand when you guys are structuring a creatively financed deal is typically you are going to offer, typically, not always, depending on the scenario, but if a seller like this who's not very motivated, has a lot of equity, typically going to offer exactly the price that they want or higher than what they want to be able to structure the creative financing that makes the deal make more sense for you. Whether it's lower interest rates, whether it's lower monthly payments, whether it's lower down payment, it's a give and take. Ideally, we buy the property as cheap as possible for the lowest interest rate, lowest down payment, lowest everything, but the seller has to agree before we move forward. So there's always a give and take. One of the best things in creative is giving on the purchase price as long as all the other terms make sense for you, which you'll know that basically based on analyzing the deal. So let's get to it. All right. So what has he said he wants in the form of down payment currently? And I'm going to assume it's a guy. It doesn't matter. It's a he.
It's $100,000 he wants.
He currently wants 100. Have you asked them and understood what do they need the money for? Have you asked that?
Yes.
What is his explanation for why he needs the money, not wants?
He is selling off his portfolio. He wants to move into commercial spaces now.
Okay. So to clarify then, in theory, he would want all the money up front, right? To be able to buy more commercial assets. Why is he willing to do this? And instead of capturing 650, 100,000, the loan amount we're taking over is 286,000. Why is he not like, so that means there's 264,000 remaining, right? So purchase for 650, you're giving him 100,000 up front, you're taking over 286,000. Means there's still $264,000 that needs to either could be paid up front or seller financed. Why is he willing to sell it and leave this much finance if he needs the money to go buy other assets?
So that I didn't ask, but I'm assuming because the market is not easy right now. It's not easy to sell off properties. There's properties that are on market for like over 100 days.
So you think this is overpriced potentially?
I don't think it's overpriced. No.
Well, every property will sell.
That's true. Right. At the right price. So
in any market, every property will sell at the right price. If interest rates are higher, he's going to have to give a lower price to make it make sense. But
right.
So he pretty much is willing to get less money up front if it means that he will get a higher overall return, essentially. It's kind of your gist of it. I mean, that's my assumption based off.
He's figured out how to get all the money up front, actually, because he said he could pull a HELOC, and that would be him pulling the HELOC with at that amount, and I would cover the cost of that HELOC.
The monthly payments for it. Yeah, so you take that over subject to as well.
Correct.
Okay, so potential. Okay, so because that's the thing. When someone says I'm selling this is what I mean by structuring creative financing. It's not always very simple or easy. You have to understand this stuff to structure the best deal for the seller. Because it'd be like, oh, I want to make this deal better for me by lowering the entry. Well, that doesn't solve his problem of needing more money to buy commercial assets. People play that game and they wonder why their offers don't get accepted. This is why. Like, he needs money up front. The HELOC is a great way to tap into his existing equity and to just allow you to take over another loan, as opposed to you personally giving the money up front, because that money would have to come from somewhere. All right, so selling portfolio. Let's do a quick thing. Let's see. This is way custom now. Let's see roughly how much you could pull out of a HELOC, assuming it's a 75% loan. I mean, there's all ranges. Like there's like 90%, 85%. I haven't done a HELOC in years, so I don't know what the terms of the HELOC is, how much you can pull out, what they're estimating is the appraised value for the property, or the terms of the HELOC. Do you know any of that?
I do not.
Like how much he thinks he'll be able to pull out of the HELOC, or you have to figure that out right now?
He told me he would pull out the whole thing at a 9%. The whole 264,000.
Yeah, let's see. So 264,000, that divided by 650, assuming that's what it's worth. That is we'll just ignore that. He wants to pull out 40% of the value, assuming this is the value. But there's a loan in place. So his total debts will be these two, because they're going to look at loan to value, and there's already an existing loan in place. That means he's roughly going to get a 15% down payment or equity in HELOC. So he's going to have an 85% HELOC.
Well, don't forget, I'm giving him 100,000. So count
right,
that.
That's the only saving grace here. The 100.
Right.
That's roughly the 15%. Like if I do this divided by that, that's roughly 15. You see how it equals this. So his existing loan plus the amount he'd pull out of a HELOC, right, would equal 84% of 650,000. That means it's an 85% roughly loan to value HELOC. And we said at 9%. Well, that's great, because all we would have to do is change this from seller finance to HELOC. So that makes it really easy. So that means there would be no seller financing needed.
Right.
Because that would be the HELOC, but you're just taking that over sub 2. It's just 2 sub 2 loans, which is fine. It's the same number. Hopefully for anyone who's lost. Yeah. The issue here is this 85% loan to value is assuming this value of the property is
checks out. Right.
So if this is 600,000, well, this number is going to proportionally go down, right? And so I would ask for that clarification. Hey, what if the bank appraises at 600 versus 650?
Right.
Would you finance the rest, right? Let's say he wants the 650, but the bank only does 600,000 for the value. Would he finance that extra 50K that he needs? What would be the scenario there?
If the property does not appraise, correct?
If the property does not appraise, to get him this 264,000 up front, would he reduce the price of the property down to the appraised value, which is your best case scenario? Like probably not. He'll probably want this, and then he'll have to seller finance the rest. Maybe, but that's where you can get very creative. He's got the HELOC. Yeah, he's got less money up front than he anticipated, but you can get really low interest on that in theory because of all this other stuff you're doing for him to get him a bunch of money. Okay. So that being said, let's assume it appraised at 650. This would be at roughly 85% loan to value HELOC between the new loan pulled out. So I'll just change this, even though it's going to mess stuff up in other areas. It's not going to matter too much. I'm not going to change any of these words. So moving forward, seller finance loan is HELOC right now. That's what we're going to think about. 9%. We're going to say it's a 30-year loan. Obviously, usually HELOCs need to be paid off sooner, whatever. I don't know his terms, but you said 9%. And we know it'll be roughly an 85% loan to value between the sub 2 loan and the HELOC. Okay, cool.
His terms are 5 years. I would have to refinance in 5 years.
The whole thing in 5 years.
The whole thing, correct.
That's why it's even more important to have an extension clause that if the property is not appraised, you get to continue with the existing debt in place, right? The debt stays, you continue just making payments that are paying it off if you cannot get a refinance based on the value of the property, especially if you're overpaying for the property up front. So it's going to be between your appreciation property value going up and the debt being paid down, plus this $100,000 you put in up front. That's when you're going to say, okay, assuming the property stays at 650,000, you would need to pay down the debt down to 487,500 to get a new 75% loan to value loan to pay off all these debts, right? Obviously, the debt is going to get paid down over 5 years, but a lot of it, the first 5 years, is a lot of interest. This loan is already owned for 6 years and is low interest. You said
right. 3.9.
So I put that here, 3.9%.
Yeah. Yeah.
I don't know what his original loan amount was. Do you know?
341.
Perfect. Do you know when it started?
So it's 6 years in. So
Just
6
give me
years ago. 6 years ago. So
6 years today.
yeah.
So
So
it's
what's that?
we'll say 9/1/2019 is what we'll estimate. It's close enough. It'll be plus or minus a couple hundred. It won't make a huge difference. So the monthly loan payment on this loan is 1608. You said he's paying
2083.
2083, right? So the full PITI, the full PITI equals 2083. So his escrow, taxes and insurance. Is there also property mortgage insurance? Like, was this an FHA loan or?
I think it was there's PMI. I think on
Okay,
that.
so we'll just say the full escrow amount,
which he can get off now. I think he actually mentioned that he might be able to get that off now.
So if it's a FHA loan, you can't unless you refinance. If it's a conventional loan, once you have 20% loan to value, you can. He obviously has way more than 20% loan to value.
Right.
The loan type. Because to give you privacy to complete this deal, I'm not going to pull up the property address, the board, all that, that just someone else can jump on that. So I don't want to do that to you. All right. So that means there's $474.61 every month being paid towards taxes, insurance, and property mortgage insurance. Right now, let's just estimate this is accurate. I can't verify that. You need to know your taxes and insurance unless you already have an idea for how much it is.
I do.
Yeah, give me.
I wrote it down.
Because at the end of the day, it doesn't really matter as long as the 474.
Yeah, it was like 2,400 or something, and I divided that by 12 for taxes, I believe.
Because without pulling up, I need to pull up the address, record.
Yeah. We actually did this already. I didn't bookmark my page.
Just give me a rough idea. Okay, so I'm going to just stick with these two numbers. So 250, 100. And then we're going to say property mortgage is the difference. That minus that minus that. So either way, this is 475 roughly, right? And that's what we're saying here. 474, same thing right there. All right. So let's finish up the debt first, and then we'll see how we can renegotiate. So just to give everyone context on what we've already done, we have recreated the original subject to loan, the loan that he bought, the loan he used to buy the property. We've recreated that because you need to understand the loan from when it was purchased. And then you are taking over this loan at some point in its ownership period. So 286,000 is roughly where it's at. We can see that by looking here. We can see what it should roughly be, assuming all this information is correct, by looking at the subject to payment schedule and saying, okay, well, if it was truly purchased and he had this loan amount on this day, this current mortgage payment as of 10/1/2025 should be around 299,000. So there's a discrepancy there because we said 286. I mean, it is pretty far off. So we need to understand why. It's $13,000 off. Has he made more payments towards principal? Maybe the loan is earlier than we thought. Do you have a mortgage statement?
No, I don't have it yet.
You need
I
that
will
to
have it.
verify this stuff, but it's okay. Not the end of the world.
I will have it. Yep.
Did you get this interest rate from him or from PropStream?
Straight from him.
Okay, because that's usually an issue where PropStream is just estimating, right? The loan amount you got from him as well, the original loan?
No, I got that from Zillow or whatever.
No, so you got the purchase price from Zillow.
Purchase price. Yes,
not
purchase
the loan
price.
amount.
He could put some money down. Yes.
Yeah, if you guys are in sub 2, you're an owner's club.
Yeah.
You're part of my stuff with the real estate super investors. You got to learn this stuff fundamentally to get really good on structuring deals. This is a big part of it. Like, understand, wait, why is there a $16,000 discrepancy? So if we know it's 286, we can just back this down to see what kind of makes sense. So let's assume it was 341 and let's just assume 5% down. So times 95%, right? Let's see what that means for where the loan would be at today. Well, actually, it says right here, this automatically tells you the loan amount you'd be taking over today is 284,877.
That's pretty good. That's pretty close. Yep.
Down conventional loan is what he did. It could have been a 3.5% down FHA loan, right? I don't know unless I pull it up or see his mortgage statement or pull it up on PropStream, which I will not do during this time. They can do a follow-up in the future. If you guys are interested, drop some love in the comments. If you would want to see after everything's said and done, Lourdes is owning this asset. If you want me to follow up and really update this thing, I don't think most people ever share that. I would love to share that if you guys are interested in something like that. All right. So let's assume it's the 5% down. The only difference here is if it's 286, that means this was maybe later in, maybe for my context, can you just text me the address? This would make my life easier. Just text me the address. Okay, I know people want that because I think a lot of people, what they do, this is why I hate social media, because all you ever get is like the tip of information that you need, nothing on strategy, process, or whatever. Or if people go further, like I'm doing right now, you'll get the front end, but you never see the reality after the fact. Well, for a lot of people who are starting out, it's kind of scary unless you are mentored by the right people who have the right education, or you've gone through the process. It's kind of scary if you don't know what to anticipate. So seeing what other people have done in the numbers and how they've changed and kind of the reality of it, I think would be beneficial to people. Just make sure to give me some love if that's something you want. I'm going to assume 11/1/2019 is what I'm going to assume. We're at 286. I can kind of do this in my head a little, like what should be changed. I'm going to just assume the first loan payment. You might have bought it in September, could have been the middle of September, but usually depending on when you buy it, you're paying the next month's mortgage or the month after that. That's probably what happened. Let's say he did buy it September 18th or 20th, October included in his first loan payment for this loan was October or November. So November. This can make sense. Yeah, am I sharing the spreadsheet? For sure. I give you guys the free version of the spreadsheet. It's functionally the same thing. The only difference that the super investors, the full calculator that I give to my super investors community or people pay for separately, which comes with its own deal analysis course, is you get to very quickly estimate capital raising. Fundamentally on deal analysis, all that, it's the same exact thing for free. You can do all forms of creative, traditional. You can do short-term, long-term, mid-term, co-living, right? Co-living analysis. The difference is the capital raising features, as well as the screen grabs of if it's PML, PMP, and the long-term analysis, the 30-year analysis, right? That's the difference. The free version, as I mentioned, you go to my Instagram, you click that link, go here, and you grab it right here, right? You just put your email in there. Or if you are in Wealth to Real Estate, we already provide trainings on a lot of this stuff. You go in and you grab the link here, grab your free copy. It'll take you to the same thing. So whether you're on Instagram or in my Wealth to Real Estate free community, you can grab a free copy of the calculator. Functionally, very similar. The only difference is primarily stuff for long-term analysis and for capital raising, which is one of the biggest cheat codes. But yeah, that's the difference. All right, let's get back to it. Let me ask you this. How many total bedrooms do you anticipate you will have once it's all said and done? Or will it be rented as a 6-bedroom rent by the room property?
No, I can add 2 more. So,
we'll add 2 more.
So I can add 2 more. Yes.
And that'll fix everything, because when there's a discrepancy between the number of bedrooms plus the number you're adding doesn't equal the total amount you're analyzing, it breaks the code. Because
Steve helped me with that, and he had added the 2 bedrooms.
Yeah, we're going to ignore the fact that you are house hacking, that you're going to live in a unit or whatever. We just need to analyze it as an investment and understand that it's going to make less if you're living in it, but you get the benefit of living in it, right? So that's when I did house hacking in the beginning. I always analyzed my properties for how would they operate, how would they cash flow, what would the returns be if I moved out, because that's the long-term goal. So to analyze it with you living there is disingenuous, right? If I get to live for free, great. But what is it going to make after I move out, right? All right. So with that being said, let's zoom back in and let's finish up the debt stuff. And then we'll talk about entry. And then we'll talk about, so let's recap this real fast. So the escrow was automatically updated too, because I did the subtraction. So the property mortgage insurance, like this was updated. So let's recap. He wants $650,000. You are going to pay him $100,000 up front. You're taking over his 3.9% loan subject to, which has a value of around $286,000, or we'll just literally take this value, because this is telling you what the loan should be today. So I've added a lot of things to like checks and balances. I think it sometimes complicates it, but the seller finance loan amount, which in this instance, instead of you seller financing, he wants that money up front. So what you're going to do, because he has a lot of equity, is you're going to do a HELOC that you'll take over subject to. This is something similar to a Morby method, where you take out a new loan to give him some of his equity, and then he seller finances you back the rest. It's to minimize your entry cost. This is different because he has the equity. He's going to take a line of credit out instead of you seller financing and a whole new loan replacing this existing one. We are combining multiple different loans you'll take over subject to based on his equity and based on what he wants. As long as it appraises, there's going to be 85% of the property value you're going to take over subject to loans. This is already the original loan plus 9% interest rate on this one. And you're paying him $100,000 or roughly the 15% down payment on this value. Okay. It's a little complicated, but it's really not that much when you fundamentally understand this stuff. There's a first position loan you're taking over. He's going to create a new loan, the HELOC that you're going to take over. And that's going to solve you having to come up with this money. Why does this work? Because he wants the money up front, right? And he's got the equity. So either you have to give him the money up front, or the HELOC is a great way for him to do so, as long as all the numbers check out. And then there is no seller financing because you're just taking this over. What was the equivalent? All right. So the HELOC is going to be a payment of $21,2360 a month. That's a lot, right? But if you were to fund that yourself, you'd either need that $263,000 up front, or you'd have to get a private money loan or a partner to fund that. This will mean that you would only need to raise money for this and any renovations and all that, right? Denise asks, can you explain again what we can do with 264? So this 264,000 is because the seller wants more money up front, right? So he's unwilling to say, hey, you buy this for 650, you give me 100, you take over my 286,000. If he sells it for 650,000 and you pay him 100,000 up front and $286,000 you're taking over subject to, well, this $260,000 is still there of value that needs to get paid out or financed. Well, because he has the equity and is willing to take out a home equity line of credit to pull the money out to use, that solves you having to pay that up front. And more importantly, instead of financing it over time, which wouldn't work because he needs that money. He wants that money up front because he wants to buy new assets. This allows him to get the money up front and for you to take over the money, as opposed to trying to raise another $263,000 from someone else. You already have that built in based off his equity. It's another loan. Yes, the HELOC is under his name for this property. He's going to pull the money out and use it. You're going to be the one to make the payments on it instead of you having to go pay that money up front yourself. Because if you tried to just seller finance it, you wouldn't solve his problem. He wants $350,000+ up front. This is a way to get him that money, but to finance it over time instead of giving it all up front or having to raise that much money. That'd be really hard for most people. Even if it's your first couple deals, it's gonna be hard for you to raise $300,000+, especially because I don't know what the returns will be on this. I assume they're not so high that you can justify a $300,000+ entry. All right. Hopefully that explained it, Denise. All right. So the HELOC will have a payment of $21,2360. The subject to loan will be $1,527.97, right? Based on the current loan amount. And then you have taxes, insurance, and mortgage insurance because of the loan product that he has. What I want you to clearly understand is your taxes and insurance will probably be higher than what he is currently paying because A, you're going to be renting it out, especially as co-living. So that all means more insurance costs. And taxes will probably be higher because you're buying it at a higher purchase price than what he previously bought it for or what the county currently assesses it for. So understand, will go up. You have to figure that out, which I have videos on. I can't do it unless I get the address. We pull the existing county records, but I have a little tool over here to help you estimate, right? Current property value, current taxes. So this is like, what is the assessed value? What are they currently paying? This will tell you the millage rate. You take the new value of the property times the millage rate will tell you what your new taxes are. So assuming he bought it for, let's say $400,000 and he's paying $3,000 in taxes. And that's a 0.75% millage rate at your purchase price of $650,000, assuming this is how its taxes are accounted for differently in every single area. That's why there's no cheat code for that. Like there is a cheat code. I provide you this link that I utilize sometimes, but it's not always 100% accurate. So we can say is assessed value is $650,000 in this, estimating the tax will be around $2,700 a year. So it's actually, I think, even less than what you have. So maybe his insurance is higher or his mortgage insurance is higher, whatever. Understand this will change depending on what you see on his. This will more likely change depending on what you see on their mortgage statement versus what your numbers will be. Just understand that, right? Like insurance goes up as a rental, especially as a rent by the room property. Taxes usually go up because you're buying it at a higher price than they previously bought it for. So you can't just look at what his current taxes are and estimate that's it. We account for the tax insurance down below. We can add roughly an extra $1,000 here for increased costs. That's for the year. So it's 33, or I think it was $80 difference a month for taxes, right? And then depending on your management strategy, you're going to have to account for the additional insurance cost based on the management strategy. Well, we already have an extra $100 a month going towards insurance down here. It's already accounted for. That insurance will be higher as a rental and co-living. I don't know what it costs there, but that's just the rule of thumb. All right. So summary, $650,000 purchase price. You're giving him $100,000 up front. You're taking over his existing $286,000 loan at 3.9% interest rate, subject to. He's going to tap into his existing equity to get him more money up front that you will also take over, subject to. He's going to do that through a HELOC for roughly $263,000 at 9%. And these are the payments associated with those two. They're just pulled down in here, plus the taxes, insurance, and mortgage insurance. So every single month between the purchase of the debts, the payments for the debts, taxes, insurance, and PMI, that's $4,200 a month every month you have to spend. That's fairly reasonable for a very highly leveraged. I mean, we're talking about $550,000 in loans, right? So that's fairly reasonable. The reason why this is fairly good interest is because of this 3.9, but this 9% is tough. But this deal doesn't work without that unless you raise money to give him that money, or you have the money to give him. And if you raise money, it's going to be at more than 9% typically. So it's still cheaper than if you were to raise money from a lender on that. All right. You said two things, which was he wants it paid off in 5 years. He wants you to pay off his loans. The only way to pay off his loan is to sell the property to pay off the loans, refinance the property and take out new debt to replace his loans, or you just pay off his loans yourself, which usually doesn't make a lot of sense. In all those scenarios, the property has to be worth a solid amount that when you sell it, you can pay off his loans. It needs to be worth that. To minimize that, I said, okay, the loan amounts will have to go from $550 down to $487.5, assuming the property does not appreciate in value. So it's got to go down $62,000 over the next 5 years. Well, the sub 2 loan you'll be paying is around $40,000 down in 5 years. And the seller finance is going to be a lot less because the interest rate is so high. These two are roughly $50,000 already. So you're getting very close to being able to do so. Between that and your $100,000 down payment to be able to refinance in 5 years, you're already pretty close to 75% loan to value. This is the exit. Like, what are you going to do in 5 years? As long as it appreciates over $12,000, you should be good, right? There's going to be closing costs and this and that. But to show you, it's not overly absurd to put a 5-year balloon here. However, this is assuming this property is worth $650. If this is worth $600 today, well, you're already $50,000 in the hole. You know what I mean? So you're going to need another $50,000 on top of this of value to do that refinance. So that's why it's important to have an extension clause to say, hey, if I'm not able to do the refinance, I want these loan terms to extend 1 year at a time until I have that 75% loan to value that I can do the refinance. It's my number one cheat code when it comes to shorter balloons on creatively financed deals. The reason why we are paying more typically is for great terms. It's to take over this debt. It's to reduce your entry costs through this HELOC. Like, that's why. Well, if they kill that within a couple of years, you want to make sure you have some protection for that. That's why I don't like short balloons. I want long balloons. I don't even know why he would care. You're the one paying all this yourself. For him, it really doesn't make a difference. I don't know what his rationale is for it, because he's not going to get any more money, really, because all the money is just paying off these debts. He gets all the money up front. So there's got to be some reason for it. Sometimes a HELOC requires certain things after 5 years. Sometimes it's 10 years. I don't know. Like, it's really going to depend. If they pull out a HELOC on his name, can he still buy a house? Can he still buy a house traditionally? Well, he's going to have a lot of debt. He's going to have a lot of debt between this one and this one. So it's going to depend on his debt to income ratio. And he's going to show after 12 months of payments that Lourdes is the one paying his mortgage and the HELOC. So the right lenders will understand that the payments for loan is not his responsibility. They will not have that impact his loan to his debt to income ratio, meaning it negates the negative impact for him to buy another property, right? Specifically the HELOC, that doesn't matter. It's just another form of debt. You can always buy properties with a HELOC. I've bought multiple properties when I've had an existing HELOC, but it's the debt to income ratio overall that you'd have to be concerned with. But Lourdes is going to have this thing and make payments over the next several years. That should negate a lot of the debt impact on his debt to income ratio, which is what a traditional lender will look at. If he's going commercial assets, it's not going to matter. Commercial lenders don't necessarily care about your debt to income. They care about the performance of the assets that you're looking to buy. They look at it as a business. Is the asset you're looking to buy good? They still want to make sure you are well structured and all that kind of stuff, depending on his loan product, but it shouldn't impact him substantially to grow and scale his portfolio unless he's looking to buy another house to live in, which then after a year, this will negate a lot of it. And the lease option that he's going to offer, that's a whole other complexity we're not even going to get into right now. let's just move forward. We have the debts, we have the balloons. It looks like it would make sense. Protect yourself with a balloon extension, right? Depending on a 75% loan to value or whatever amount you're looking for. Patty says HELOC as a way for him to leave some equity and Lourdes takes over the debt is an interesting move. It's very logical if they have the equity to be able to do so, because he needs the money up front. And for Lourdes, instead of giving the money up front, it makes more sense to make the payments than to pay $264,000 up front. It's very good way of solving his problem and giving him money up front. Probably the most cost-effective way to do so. The only other option would be if he didn't need the money up front, then he would just sell or finance it, but he wants as much money as he can. He wants all of his equity. This is the way that he'll get it, right? He gets the $100K up front and the rest through the HELOC. Like I said, this is like kind of what a Morby method solves for, you go new loan, new commercial loan to pay off their existing debt, give them money up front, and then they finance you back. But in this instance, he gets all of his equity up front. It's even better because of his current loan to value and the amount that Lourdes is paying up front, assuming this thing appraises at this value. I'm getting in the weeds for a lot of people. Patrick says, suppose a 5-year balloon, the seller has a HELOC. What stops the seller from refinancing the HELOC at 3.5 years in order to take out more money at that point? You have to clearly articulate that in your documentation. This is why it's so important for you to have a great transaction coordinator. If you need referrals to the ones that I use the same ones every single time. If you want those referrals, just reach out to me. I'm more than happy to give you those referrals. I don't want to blast them right now, but if you want that, just reach out to me and I'll let you know. I'll connect you. What that will do is the same concept. What stops a seller from pulling money out of a property they sold subject to? Well, that's in your documentation, right? They can't take out new loans against this asset. It would be a violation of the contract. What I would do in that instance, well, we're not going to get into the weeds of what I would do. All right. So the debts, the structure, we understand it, why we're doing it. We recreated the original loan. We understood this is just the loan payments, taxes and insurance plus PMI are also making part of that mortgage payment because that's principal and interest of the loan right here, PITI of the loan, principal and interest of this original loan. And taxes and insurance and property mortgage insurance are also paid as part of your mortgage payment, right? That's the escrow piece. PI and then TI plus he's got PMI because he put a lower down payment. Way in the weeds. Just understand that stuff. Also understand that your taxes and insurance will go up depending on, typically because you're buying at a higher price, depending on what it was last assessed for, which I can't verify right now without the address. And insurance, because you're going to, instead of them living in it, it's a rental, and it's a rental that's being operated as a co-living, it's going to cost more. This is accounted for in expenses. This, we added $1,000 in general. Even if these numbers are wrong, the total makes sense. We're just increasing the total monthly payment by $88. And we're going to add another $100 a month for the insurance because that's still the same payment. That doesn't change your cash flow. All right, let's do the entry. So you are paying him $100,000 up front, no agent involved, right?
Nope.
And you have no wholesaler. This is just you.
That's right.
You're doing all this. Are you paying anyone for any of this stuff? You should pay me, but that's later. No, I'm just kidding. There's no one involved you have a fee to, right?
Pardon me?
No other fees that you have to pay.
No other fees. No other fees. No.
So you have closing costs, which was estimated at 2%.
Yeah.
If I was you, because you're giving him all this money up front, I would tell him he's got to pay his portion of closing costs. You guys will do 50-50, and that's going to come out of the down payment you provide him.
Oh, okay.
That's the implication. You know what I mean? Like,
okay,
you this money up front, use that to cover some of your closing costs, which means your closing costs could be less than this. Sometimes for creative, if the seller has no equity, the buyer is paying it all, right? I wouldn't necessarily do that in this scenario because you're giving him a great price. He's getting a lot of money up front. He should cover his closing. There's no reason why he couldn't unless he's being stingy, right? And for you want less money in the deal. This is one of the ways to do so.
Okay, thank you.
And then reserves, we'll just estimate 3 months of these payments. Okay. So you said you're going to add 2 new bedrooms, but have you had a contractor go and see what that would look like?
No, my son was there today, but we probably won't do that until later on. Right now, he's currently Airbnb-ing the bottom part of the house, and that's sort of broken up into 3 sections. And he's making, he said $70,000 per year.
Unless you're doing that, it's not going to matter. Like, unless you're and understand this, that your debt payments is $4,200 already.
Right.
Just this stuff, no expenses.
Right.
That times 12 is 48,000, already 50,000. Once you account for expenses, other expenses, all this other stuff, that 70,000 is irrelevant. Like that's already washed away. You're losing money. But understand that he's living in part of it or something like that.
Correct.
Okay. We're going to assume once again, this property's fully rented out by the room, not you living in it. Okay. Yep. If you want, what we could do is we can analyze it without these additional costs and the additional income and the additional 2 bedrooms and just look at it at face value. My question is the rooms that you're going to convert, I recommend doing all renovations up front. It's my personal recommendation because it's easier before you have any tenants in place. It's way easier, faster, cheaper. Do it all at once, all up front. Although you're not going to, it's not going to be cheaper because you're going to do it all at once in the future, but it's going to be easier for you and not impact your property if you do it before everyone starts moving in. Okay. I'm going to assume that you're going to do this anyway because this is what your plan is for it.
Correct.
So are you like converting a living room, a dining room? Like what are you trying? How are you creating these rooms?
I would convert one dining room and one, they're calling it a study, which is a smaller room. Yeah.
Dining rooms and studies, office are the best things to convert. So you're adding 1 or 2 walls and a door. That's
correct.
It.
Correct.
This way. Perfect. The 6,500 is more than sufficient per room, assuming that's the case. Then you're going to furnish all 8 bedrooms plus common areas and all that, which
it's already furnished.
Great. So it's going to be even cheaper for you.
Yeah.
So all you're going to do is furnish 2 bedrooms, right?
Correct. Correct.
So we change this instead of this being a format that says 1,200. Let's just change this because it's saying 2 bedrooms, like the formula. If you click it, it says the 2 bedrooms plus the 6 times 1,200 a room, right? That accounts for furnishing the bedrooms and the common areas. Most of it is already furnished. Most furnished.
Right.
Only 2 new rooms.
Because he was using it as an Airbnb. Yeah.
So because it's going to be 8 times that, let's just put 250. So it's $2,000 to furnish the other 2 rooms.
Okay.
And you even cost that, honestly, to furnish your bedroom. But it's good to have that in your budget. So in total, it looks like you're going to spend around $150,000 or $145,000 to buy this property. That includes the down payment that we talked about, the closing costs,
right?
Paying for a TC, forming your LLC if you're going to buy an LLC, the inspection, all that stuff, which can be in the closing costs. I separate it because I get reimbursed after I raise money for my partners for the stuff I paid for in advance. Whatever. Here it's $15,000 for closing costs, $15,000 for reserves. So it's $145,000 is also reserves. Like that also accounts for 3 months of reserves, roughly $5,000 a month for you to buy the property, then renovate it, furnish it, and rent it out. Well, it's going to take you less than a month to renovate and furnish because most of it's done. It's an easy renovation and most of it's done.
Correct.
You said 4.5 bathrooms. Beautiful. 8 bedroom, 4.5 bathrooms, a beautiful ratio. And you're doing a great market too, actually.
Yeah.
So your reserves could actually be less than this, but this gives you roughly 2 months, right, of reserves, just knowing that this money may be spent to get the property fully rented out.
Right.
Right. That's plenty of time in a market like this. You're not doing it I know the market you're doing. It's a great market overall. It's already a great co-living market. And a lot of people, they don't even need PadSplit. They do it themselves. So if they can do it themselves, if you use PadSplit or not, you're going to have an easier time to do it. There's a lot of people in that market that you're looking to own this in that are doing self-management for co-living. So either you hire them, you do it, whatever your plan is, but I'm just saying it's a good market because of understanding that. This is why it's important to work with people who actually do a lot of co-living, who understand co-living, who operate in lots of markets, because then you have insights to these different markets. Or myself, who I don't own in this specific market. I own multiple in this state, but not in this market. But I also know lots of people in this market that already know a lot of this stuff, or that I know what their current success is.
Can you share some of those with me at some point?
I will share those with you.
I may need them.
I got you. All right. So let's continue on. So 145,000, but reserves, right? And so understanding you in particular are going to self-fund this 100K. You're going to fund all the entry. So up to 150. Okay.
Yes. Yes.
So when I'm raising money, I want to make sure I'm raising the maximum amount in the sense of it's better to raise money with the reserves for the renovations with a little bit of cushion, because it's better to raise the right amount of money, base your partnership split on the kind of worst case scenario, the maximum amount, so that your partners are getting what they expected when they put the money in. The extra money goes towards reserves or you pay that back to people. Great. And it's your own money. You don't need to necessarily do that because you're going to have to fund the reserves and stuff. You don't need reserves. You just know you're going to have to fund this stuff as it comes up. But for the sake of analyzing effectively, let's go with that. So purchase, debt, fixed expenses, the mortgage and all that stuff, your entry costs for the property and the reserves is already accounting for the expenses based on co-living. Your total entry is 145. let's talk about income. It's going to be 8 total bedrooms. How many are private? How many are shared bathrooms?
2 private and the others are shared.
So 6 shared. Great. Do you know roughly what you're going to get in income per week or month on these?
Yeah. So according to Pad Split, there $330 for the individual and $270 for the shared per
I'm
week.
going to show it real fast. So I'm going to just very quickly touch on this. Very quick. We're not going in the weeds because I've done this so many times for you guys. And if you want to learn this stuff very detailed, come to the CoLiving workshop, or if you can't make it in person in San Diego, September 20th and 21st. If you can't afford it, I get that. Come to our free meetup on the 19th. It's going to be awesome. Lots of value. If you can come in person to the CoLiving workshop, do so, because there's going to be a lot of awesome people that they connect with, partner, all these good things, and learn directly from me. But also, if you can't come in person, the price is so freaking cheap, in which you get a full CoLiving course. People charge $10,000+ for the same thing. You get access to that CoLiving course. So take advantage of it. You get all the detailed, or scour through my YouTube and Wealth of Real Estate and all that to get that information. Colorado Springs, we're just going to look at the total market. So there's not a big pad split reach nonetheless, but I know lots of people who self-manage there. Pad split is just expanding there. So I get that.
It's an emerging market. Yeah.
Yeah. 210 per shared, 281 private bathroom. This is such few units. I'm not very confident in these numbers. And you can see that here in the occupancy data. However, as a rule of thumb, we can use it for the sake of this analysis. I would ask you to start looking on Zillow and other places to see what other people are charging rent by the room for. It's not like their Atlanta market where they have tons of units and very confident data here.
Right.
It's a newer market. You're going to want to get additional sources for this income. For my super investors, I have a whole list of like 10 different places you can get rent by the room data. Okay, I gave you one, right? Zillow's a very obvious one. You can search rent by the room. We are not going to do that right now. 210, 281. Is that the numbers that you said?
No, I had a little higher.
Go for it. Well, your furnishings are going to be way higher as a short-term rental going CoLiving than the typical CoLiving in a market. What do you have?
At 270 and 330.
Oh, I think those might be too high. How did you get those numbers?
Furnish finders.
For by the room? Furnish
By
finder
the room. By the room.
Okay, I would ask you to deep dive into those numbers further.
Okay, we can go with the lower amounts. That's fine.
No, I don't care. It's your deal. I just want to say, like, I can't say that pad split's accurate because there's only 14 active units.
Right. They didn't have many. Yeah.
That's irrelevant. Like, we can go on Zillow and all that. We've already exhausted our time. I just want to get you something to get your foundation set so you can leverage this and finish your analysis, because we've got the majority of it here.
Right.
We're going to update this number. All right. We're going to assume a lot of this is accurate unless you have some updates. So we've got the entry, the total entry for the deal, which accounts for the renovations and furnishings after we did all the debt and all that good stuff. We have our income for the property, right? The weekly rates, and this translates to a monthly rate. And then we have expenses. So the fixed expenses, right? That's already what we did. Loan payments, taxes, insurance, all that good stuff.
Correct.
So what we need now is to understand, we're going to estimate $100 more a month for insurance than what he's currently paying. Do you know anything about the utilities in this market?
Roughly? I asked. He said 400 were his gas and his electric. 400. That's what he pays monthly.
Gas and electric total is 400.
Correct.
And you have even more tenants in there, so I'd assume at least 500.
Maybe. Okay? Yeah.
So I'm gonna go 250 and 250. Oh wait, just gas and electric. What about water and sewer?
He didn't say water and sewer. He said total utilities were about 400, but I do want to see some of the bills and stuff. So
I would ask for those bills.
Yeah, I have asked. Yes.
Okay, so the cool thing here is if he's paying 400, does that include garbage and all that too?
Yes.
Is he including internet in that or no?
Yes.
So he's
garbage, snow removal, and some other things. I forgot what.
Yeah, landscaping / snow removal. What else?
I think that's as far as we got.
And all that stuff. Okay,
there's no HOA.
No, there shouldn't be if you're going co-living, in my opinion.
No.
All right, so we have 525 for landscaping and snow, internet and Wi-Fi, garbage, gas and electric, water and sewer. He said 400.
Correct.
So going roughly, what is that? Like 20% more?
25 with the extra 125, yeah.
Like 25% more. I think that's conservative. You're going to have more people in here than he did right previously.
Yeah.
So your utilities are going to be higher.
I would agree. Yeah,
I would agree. Add a little bit more to be extra conservative, but understand that if you're wrong, fine, you make less cash flow. So there better be a big cash flow spread. And I assume you will. I mean, especially with this income and these, oh, you know what? Not really. Let's see. How are you going to manage it?
I'm there. I'm going to self-manage it.
Okay, what are you going to charge yourself for self-management? Because remember, you're not going to be there forever.
That's true. So let's put in the correct numbers for management. He's actually going to send me some of his own, his already existing.
But through pad split or separate? Let's just
No,
assume
separately. Pad split is not there.
Yeah, let's assume you're just paying a property manager 15%.
Yes.
You need to talk
Correct.
to managers there because some will charge lower, some will charge substantially higher. You need to understand that in that market. I don't know in that market. I honestly don't know what property management is.
I think I was assuming 8%. I'm not sure what they're
No.
going to charge.
That's long term. That's the lowest, like long term, potentially because 8% translates to a lot of money per month. That's $800 a month because it's higher income. However, I wouldn't estimate anyone would do that still. I would estimate roughly 8 to 10% long term, 15 to 25% for co-living. It really depends. 15 to 25% for midterm, and then 20 to 30% for short term. Some rules of thumb, but it's really market dependent. For my multi-million dollar property in San Diego for short-term rental, it's 15% because it makes so much money. So it varies, right? So it really varies based on your market, the property, and all that stuff. Obviously, the strategy as well. Vacancy. Are you estimating 8% vacancy roughly? So 1 month of the year, each unit is vacant roughly?
Yeah, at least, yeah.
Yeah. And then 6% for maintenance and CapEx. Is it already in pretty solid condition?
Very solid, yeah.
So the 6% is really good then because that's $600 a month for maintenance and capital expenditures. You're going to need the inspection to check the roof and all the age of everything. But I assume as a short-term rental, even if he did it all 6 years ago, still gives you a lot of life on a lot of the things that he's buying.
Yeah, he did a lot of it. I saw the permits that were pulled.
So based on this, based on your higher income projection of 98.80 a month, right? Based on the 330 and 270, and all the expenses, including slight extra for expenses, and accounting for an extra tax increase of $1,000 a year, and insurance being $100 more a month than it would have otherwise, all that stuff, we're looking at an income of 98.80, $5,000 a month in expenses, plus 1482 for property management, plus 1383 a month for reserves for vacancy, so the property not being rented out, and $593 of that going towards your reserves for when maintenance stuff comes up. You got to fix a plumbing leak, you got to change basic maintenance, and setting aside money to replace your appliances, to replace all that good stuff. So Patrick, what time is your free meetup? Okay, so it's 6 p.m. PST on the 19th, I think. 6 p.m. PST. I'm going to be posting more about it. Just all you need to do is be part of either Super Investors or Wealth Through Real Estate, and you'll get all that information. I will have a link for you to register for that and get everything within the next few days. It'll be out. So by the end of this week, you'll have a link to register for the meetup. Okay. Just want to answer that real quickly because I want this to be huge. I want everyone to get a lot of value. For those coming to the workshop, come a day early and be part of this meetup, right? Connect with lots of people and potentially even meet people who want to be your capital partners on future deals. Like, it's cheat code. All right. So with all that, assuming all the reserves and everything, you're looking at $2,000 a month in cash flow. Awesome. When it's fully rented out. And your cash on cash return, your cash flow times 12, so your annual cash flow, 24,000, divided by your full expenses, which accounts for reserves and renovations and all that, is 16.6%. Both of those are very solid numbers. I would buy this property 100% like this. Like, I would do this. The difference is I would not put in my own money. I would instead go to, like, for those of you who have the Super Investor, the full calculator, I would say, how much percentage of ownership and cash flow would I need to give up to give my partners a solid return? So in this instance, they bring in 145. I give them 40% ownership and cash flow. They get a 7% cash on cash return, 21% return on investment year one. That's over your head. Don't worry about it. You're probably not even in the right position to even think about stuff like that. However, this would mean I could buy this property and give up 40% of the ownership and keep my $145,000 to do whatever else I want with it. My partners would get solid returns. I can raise this money very easily from my experience. That may not be the case for you. Depends on where you're at in your journey. That's what I would do. Or I would say I need 145,000. What I'm going to do is I'm going to put in, this is a freaking cheat code for you guys. Like, you're welcome. $50,000, let's say, instead of the full 145, so roughly a third. And to get them back to around a 7% cash on cash return, so I would give them 30% instead of 40%, and I would only put in 50,000. If you're putting in your own money, you're going to get a 16.6% cash on cash return, right? That is your cash on cash return for all your money invested. In this instance, you only put in 50,000, leaving you roughly another 100,000 to go buy 1 to 3 more properties. And your returns are not just 16.6%, but because you're putting less money in than you would have otherwise, but you're keeping the majority of ownership, your cash on cash return is not what it was before. It's 35.78%. And your return on investment, all that is way higher. So you're getting more return than the amount that you're investing. And your partner ends up in a scenario in which they're getting a higher return they would have previously, even though the ownership percentage is lower. You're splitting all the benefits between everyone. Everyone ends up winning than if you just use your own money. The difference is if you don't put in your own money, you get infinite cash on cash return. But understanding that it is harder for someone when they're starting out to raise money. It is harder for you to raise money if you don't have some skin in the game, right? So putting in some money to start off, especially in your situation, you're going to fund all of it. And as a super investor, this is exactly the type of thing I'd recommend you do instead. Because then you'll learn how to raise money, you'll split ownership, you'll do all that stuff. And you can negotiate with them that, hey, for the first year or whatever, the returns are going to be lower because I'm going to live in a room. I will pay rent at this specific amount. You can do whatever you want. It's up to you specifically how you structure it. But because this is a great deal, it makes me think immediately you can raise money for it. What I wouldn't do is raise money from a private money lender because that's going to eat, you'll still get infinite returns. It's going to eat all your cash flow. And you're going to have to figure out how to pay them $145,000 in a year. It's just too much money to figure out how you're going to deal with in a year. I would go the route of either using your own money if you choose to, which is lower leverage, but you get to keep 100% of the ownership, which is nice, or raise some of the money or all the money to buy the deal. Because either if you raise all of it, you get infinite returns. If you're not able to raise all of it, let's say you put in 100,000, right? So you only need to give, and someone else puts in 45,000. So instead you give up 15%, you raise $45,420. The next time you go to buy a property, you've already got all the confidence, experience, skills that you need to be able to raise money because you've already done it. Yeah, you put in some of your own money, but that's when you're starting out to help your ability to raise that money. And now you have an extra $45,000 to play with. You still keep the majority of ownership and everyone wins in this scenario, right? And this is all dependent on I can't tell you because I don't know. I just raise 100%, so I get infinite returns, right? For you, you might be able to raise, this is saying you roughly raise 33% of the 150, right? So let's just change this so it's easy math. So we're going to say, what I do here equals plus 150 minus, what was it? 145, 420. So now your total entry is 150, right? So you put in 100,000, 2/3 of it, they put in 1/3 of it, right? And then you could just play with these numbers and see what it would look like. But you have to start this conversation with people. And based on these returns, you might have to offer 20% because they want higher because you're newer. Or they understand, hey, I'm putting in $100,000 of the 150. Like I've got a lot of skin in this game as opposed to lots of capital raisers who have no skin in the game. Just to recap real fast, we had the motivation and what the situation looked like. You had some preliminary info on what he's looking for. And we talked about like what makes sense. Oh, why he would want the HELOC. We structured, it's really not hybrid crave. It's subject to in its entirety, the way that we've structured it only, but we're using the seller financing to talk about the HELOC in this scenario because the calculator can do that in that sense, right? You just treat, because seller financing is just to take out a new loan. Well, we're doing that through the HELOC. You're just taking over the responsibility of payments on that. We talked about the purchase, the down payment, the sub 2, and how to recreate that and understand, hey, why was there an issue? Why is there a difference between what he has on the mortgage statement and what you have is what the loan amount should be? And we got there. We figured out, put a 5% down payment.
Down payment.
Yeah. We went through all that, recreated the loan, the estimated the taxes, insurance, PMI, got the entry costs. You understood how many more rooms you can add. We estimated the renovations, the furnishings. Yours are way cheaper because you're only furnishing the 2 new rooms that you're renovating. Went through the income based on your projections, right? If this really is like 250 or like 280, and 220. Obviously, this deal does not work anymore. Like, right? So if these are the real numbers, this deal is a lot lower returns. I wouldn't deal with that. Maybe it's somewhere in the middle. You need more info. Don't just use pad split because their info is so limited, because this is
It's not yeah, it's an emerging market. It's not there yet.
14 units means 14 rooms for rent. That's 2, 3, 4 properties at the most.
Yeah.
You know, that's nothing. That's literally no information to make an investment decision on. So right now, until they expand and get more data, use other data sources. There's plenty of them.
Mm-hmm.
All right. So let's put that back, because I assume these numbers came, well, you said from Furnish Finder. I would look at more than Furnish Finder, because Furnish Finder is at a
Well, I actually do have a call into pad split, but for the Colorado Springs person.
Good. All right, good.
So I'll get back to them. I'll get more information on that.
Yeah, and if you use their reps, right, you get street by street, very property by property data.
Right.
They'll show you, hey, and they'll see your property and say, hey, compared to a lot of these properties, they don't look nearly what you're offering. I have properties that are a premium because I'm buying short-term rentals that are failed, and then I'm buying them creatively because they suck as short-term rentals. They just want to get out of it. They don't want to keep losing money. I'll buy it and rent it out co-living. Well, not only did I get into it for actually little to no money down and typically at good interest rates, but my properties are way nicer than what everyone else is offering, because it used to be a short-term rental compared to a midterm / co-living rental. So it's way nicer, way better amenities, looks way nicer. People pay a premium for that. But don't shoot yourself in the foot by overestimating. If you're wrong, worst case scenario, and you're just funding it, you might make less cash flow. It's not the end of the world, because you have so many reserves already accounted for as well.
Right.
Right. So there's just understand that it's real estate investing. There's risk always involved. Do your best to minimize the risk by having really good data when you're analyzing. Number one thing you can do. And understand that if we didn't need any of these reserves right here, these reserves, we're looking at $3,391 a month. That's impractical because you're going to need reserves, but just to give you kind of the lower to higher end of the spectrum, what your returns would look like. So there's a lot of wiggle room in here is what I'm trying to say. We are not even going to deal with offering different scenarios and all that. I would try to see if he's able to structure this deal and what the HELOC would look like. That's going to change everything for you. Or if he's willing instead to finance some of this, it's going to impact your cash flow, but you put less money in, which could be beneficial. That would be helpful. Or if he needed less of this money, so he pulled out a smaller loan, he did seller financing in addition to this. Let's say he pulls out $200,000, which is going to blow it up. This is wrong, but that extra $63,000, like this is a perfect case scenario, right? No payments till balloon, right? So this $63,000 is no longer impacting the monthly payments.
The monthly payment, yeah.
You're giving him $200,000 up front through the HELOC and $100,000 down payment, right? This is what I would say. If this appraises under, I will pay you that in 5 years. No payments, I'll pay you that in 5 years. That'll be in our note, right? I'll pay you that amount in 5 years. Your cash flow is way higher. You don't have to try to figure out how you're going to come up with that money up front, because that changes from, 150 to 200 plus now. And look at what it does to your returns. Way higher than it would have been otherwise. You just added, I think, $500-$600 of cash flow a month, and your cash on cash return is higher. Yeah, you have to pay them back that amount in a couple of years.
Right.
But that's the scenario in which you get to play with, because he has a lot of equity. This is why I love seller financing component into any deal, because that's where the most wiggle room is. All right, cool. I will send you this spreadsheet, you specifically, Lourdes, so you can have it.
Awesome. This was amazing. Thank you so much.
You're welcome.